Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Zomedica's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Zomedica develops and markets pharmaceuticals for pets. It created Truforma, which will help vets diagnose pets much faster than other devices. It is a blood testing kit for veterinarians. It's based on bulk acoustic wave sensors from the company Qorvo, ticker QRVO. The waves run through the pet's blood sample to test for adrenal and thyroid diseases. The cost to buy Truforma is $8,750. The device is protected by 70 issued and pending patents. The global diagnostic market for animals was $6.2 billion in 2020. The US market is about 1/3 of that, so this is a really big market for a lot of opportunity. This month it acquired Pulse Veterinary Technologies for $70.9 million, all in cash. This company develops electro-hydraulic shockwave technology for the treatment of a wide variety of animal conditions. The technology is used in conditions affecting tendons, ligaments, osteoarthritis, chronic pain, and wounds. It is the leader in the equine space with 1,500 of their systems currently being used. This month, Larry Heaton has been appointed president. He will assume the role of CEO on 10/31 when Robert Cohen retires. Larry has 35 years of experience in the medical device and biotech industries with a focus on commercialization and business development. So he seems like a really good fit for this company. The company is headquartered in Ann Arbor, Michigan, and was founded in 2013. It trades on the New York Stock Exchange and TSX Venture. Let's get started with the model. This is a small cap company, 504 million market cap. They're trading at 51 cents a share, and they have 980 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they are pre-revenue, so they have negative free cash flow and negative net income each year. They just started getting revenue in the first quarter of 2021, but my numbers are in millions, so it's rounded down to zero. This is the company's income statement. The top line is the revenue, the sales. They got their first sales in the first quarter of $14,000, then $16,000 in the second quarter. They started to commercialize Truforma in March of this year, but sales have been limited. In their second quarter report, they say sales have been adversely impacted by delays in the development of our FT4 and ACTH assays. So this seems to be an issue in their supply chain. The company does say we expect the FT4 assay will be available for commercial sale in the fall of 2021, and the ACTH will be available by the end of 2021. So it looks like sales should be pretty low this year, but next year is when it should take off, if it does. Below revenue is their operating expenses. That's between $16 and $20 million a year. Below that is their operating income, which of course is negative every year, and they have negative net income also every single year. These are their expenses for 2020. $8 million in R&D. This is the process a company uses to obtain new knowledge and use that to improve existing products as well as to introduce new ones. So part of R&D expenses are the payroll for the employees working on the research and development, also amortization, depreciation, materials, equipment, and also the facilities. They spend $6 million in G&A expenses, $2.2 million in professional fees, amortization of $220,000, and $300,000 in depreciation. It has very little debt, so only paid $732 of interest on their debt, but they received $32,000 of interest on their investments. And it looks like they passed through a loss of $121,000 on the disposal of an asset. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. So since they're pre-revenue, they lose money every single year. They spend a little bit in CapEx as well. Operating cash flow minus CapEx gives you your free cash flow. And they're running their business on capital stock. They issued $15 million of stock in 2019, $56 million in 2020, and $229 million in the trailing 12 months. It's better to issue stock than debt, because when you issue debt, you have to pay the interest on your debt. when you're pre-revenue and you don't have cash flow, that's not such a good idea. They have $276 million of equity. They raised $385 million from selling their business, and they lost $110 million from running their business. Let's look at the capital structure. $276 million of equity, $1 million of debt. So they're 100% equity. Their net debt is negative $275 million. That means they have $276 million of cash on their balance sheet, which equals their equity amount. So almost all their assets are cash. And their weighted average cost of capital is 9%. That's the highest WACC according to Finbox. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $721 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $504 million. We divide that by 980 million shares. And we get a calculated stock price of 51 cents. So I didn't really value this company. It would be a total guess. I just showed you one scenario what their future free cash flows would need to be to justify a 51-cent stock price. So they would need $46 million of free cash flow by 2024, assuming they had negative in 2021, 22, and 23. The average company converts 10% of their revenue to free cash flow. This implies they would need $460 million of revenue by 2024. Do you think they can do that? If so, then the stock is a buy. According to Yahoo Finance, one analyst rated the stock a buy in August, and in September, one analyst rated a buy. In October, no analyst rated the stock. I only found one website that gave a price target for this company. It was on wallstreet.com, and their price target was $1.20. This is where the stock has been trading the past 52 weeks. So there was tons of activity on this stock for a long time. You could see all this trading activity, and it really pushed the stock price higher, over $3. So you could have 10x, 20x, 30x your investment if you bought it anytime down here. And this is around the time Truforma came out. You can't wait for the product to come out to buy the stock. When I first did this video, someone commented, I'm going to wait to see how their sales are. By that time, everything is priced into the stock. You want to buy the stock well before they commercialize their product. And you might have to wait a few months, sometimes a few years, and it can be stressful to see a flat stock or a declining stock. Once the stock price gets up here, if the sales are amazing, the stock will come down, probably around here, $1.50, and then it will come back up, past to where it was before. But if their sales are weak, which they were, the stock price will still come down, but then it'll come down even more, as it did. So I think this could be a really good swing trade, because I'm pretty sure the stock will go up. I can't say for sure if the stock will stay up, but I'm pretty sure it will go up. But I personally don't invest in stocks under 1 billion market cap. It is possible I could have 10x or 20x my money on this stock, but if I did it for all stocks under $1 billion, overall I would lose money. And they have a low beta, 0.42, so the stock moves half the market. It's not volatile. It went up nearly 500% in the past 52 weeks. Because it was so low 52 weeks ago, it's up 5x from that point. That means the stock was trading at about 10 cents last year. While the S&P 500 is up 25%, the 52-week low is 6 cents, the high is nearly $3, and the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. Over 20 million shares are traded each day. Of the 980 million shares outstanding, 956 million are on float, 16% are held by institutions, and over 9% of the shares are shorted. So you can see the short percentage has been climbing. It was pretty much nothing for a while. It got up to 7%, then it came down, but now it's getting to its highest points, 9-10%. Their employee count was really low in 2016, then it climbed, then it came down a little bit. I'm not sure what it is in 2021, but this is as of the end of 2020, only 19 employees. If you invested $10,000 into this company in 2017, you would have lost 80% of your investment. The biggest shareholder is Vanguard at 4.3%, then State Street, BlackRock, Renaissance, and Savvy Management. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a crazy high price to sales of $17,000, and they have a good price to book because they do have a lot of cash on their balance sheet from their recent capital raises. They have a really high current ratio, a really high quick ratio. They have tons of cash on their balance sheet, $276 million. So they're really well capitalized. Even though they had negative $13 million of free cash flow, they have a lot of cash to get through the next few years. They did use $71 million of that cash to acquire Pulse. but they still have about $190 million of cash left over after that acquisition. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 20 companies in the same industry as Zomedica, and they have really weak ratios since they're pre-revenue. Terrible price of sales, they do have a really good price to book, a high current ratio. Their ROE is negative, but the average is negative 30% because lots of companies in this industry have big losses. They're 0% debt and they're a really small company, $500 million market cap. So to summarize, I think it is a good sign they acquired a company that's generating revenue. It'll make their financials look a lot better, seeing some revenue on the income statement. But the real test of this company is if Truforma will be successful. Obviously, it can go either way. They put a lot of time and money into it, so the hope is it will be successful, especially if you're an investor. Scaling a product is not an easy thing. You could develop one product or two products and have it work well, but to make thousands or even millions of those products and have them all work well, or at least majority of them work well, that's a totally different animal altogether. Because there's always supply chain issues, which they're having right now. But the stock is so cheap at 50 cents, it's so much cheaper than it was a few months ago. You can't really lose much money except 50 cents, but there's a lot of upside. So I'm really excited to see how this company progresses in the next few quarters. I rank their free cash flows, revenue, and ratio as 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.